You open your brokerage app, your $400,000 S&P 500 fund now reads $212,483. That's not volatility. That's years of your life erased without a single bad decision. This math already happened once in 1972 when the safest stocks in America fell 60 to 90%. Investors back then weren't gambling. They owned Coca-Cola, McDonald's, Polaroid, dominant, global, profitable businesses, and they still got crushed, not because the companies failed, but because the price they paid guaranteed disappointment. In the next few minutes, here's what happened. A market trading at extreme valuations, combined with one macro shock, erased half of portfolios and delayed retirements by nearly a decade. Today's top 7 stocks, now roughly 36% of the S&P 500, create the same math problem. Let's make this concrete. You're 42 years old with $400,000 invested in an S&P 500 index fund. You've done everything right. Automatic contributions, no day trading, no chasing headlines. A 50% drawdown cuts it to $200,000. Here's the part most people miss. A 50% loss doesn't need a 50% gain to recover. It needs 100%. At long-term 8-10% returns. That's 7 to 8 years, just getting back to even years spent digging out instead of compounding forward. This isn't theory. In the early 1970s, a group of elite stocks known as the Nifty 50 made up roughly 45% of the US market. Today, the top 7 companies make up about 36% of the S&P 500. Different names, same concentration risk. You think you own 500 companies. In reality, more than a third of your outcome depends on a handful of mega cap stocks. Here's the math. If 36% of your portfolio drops 40%, you're down about 14% instantly before the other 64% of the market even moves. That's enough to turn a calm year into a painful one. When leadership is concentrated, small resets in a few stocks create large portfolio consequences. Now let's look at why this happened in the 1970s and why it matters. A normal market might trade at 15 times earnings. At 40 times earnings, investors are optimistic. At 80 times earnings, perfection is priced in. If you buy at 60 times earnings and that multiple falls to 25 times, your account can drop about 55% even if profits keep rising. Nothing breaks. Your retirement math resets. In the early 1970s, many of the Nifty 50 traded around 40 times, 50 times, even 80 times earnings. The broader market was closer to 15 times. Investors believed these companies were so dominant that price didn't matter. Buy and never sell. Then the macro regime changed. Inflation jumped from roughly 3 to 11%. Interest rates followed. When rates rise, expensive stocks fall hardest. Unemployment doubled from about 4.5 to 9%. Oil prices surged. The US ended the gold standard. As interest rates rose, the present value of future profits fell. Picture this, it's 1973. You own what everyone calls the safest stock in America. Earnings are still rising. The company is profitable. The brand is dominant. But the P/E ratio falls from 60 to 25, your account drops 55%. Nothing broke. The price reset. Investors paid tomorrow's returns up front. When inflation spiked, tomorrow was repriced overnight because so much money was crowded into the same names. The fall was sharp. When leadership is narrow, selling pressure hits the same stocks everyone owns. There aren't enough new buyers at extreme prices. Crowded trades unwind fast. One rule matters: high valuations plus narrow leadership equal fragile future returns. Now, bring this back to your index fund. On paper, an S&P 500 fund looks diversified. 500 companies, broad exposure, low cost. But market cap weighting means the biggest companies get the largest weight. Money flows into index funds. Index funds buy more of the biggest companies. Their prices rise. They become a larger share of the index. That attracts more money. It's a feedback loop. It feels safe because it's popular. Popularity is not protection. Right now, roughly a third of your index is concentrated in a small group of mega cap stocks trading at premium valuations. If those stocks stumble, not collapse, just reset, your portfolio feels it. This isn't a crash prediction. It's a reminder that when valuations are high and leadership is narrow, future returns are fragile. Fragility shows up when you least expect it. Now consider the retirement impact. An 8-year stall doesn't feel dramatic. It feels slow, but it changes your future. So you have $500,000 invested and you're planning for a 7% annual return. On paper, that grows to about $983,000 in 10 years. That's the number behind your retirement plan. Now change one variable. For 8 years, the market goes nowhere in real terms. Then it resumes normal returns. You planned for $983,000. After 8 flat years, you're closer to $600,000. That gap changes your lifestyle. Here's the chain reaction. High starting valuations, D, lower future returns. Fewer effective compounding years, CD, forced adjustments. If you're near retirement, timing matters even more. 2 retirees start with $1 million. One gets strong returns in the first 5 years. The other gets flat or negative returns early, then strong returns later. Same average return over 20 years. The second retiree runs out of money sooner. Why withdrawals during a stall shrink the base that is supposed to recover later? Sequence risk is timing risk. Here's the pattern. Great companies, high valuations, concentrated ownership, macro shift, valuation reset. The tragedy wasn't buying bad companies. It was buying great companies at prices that guaranteed disappointment. Now, the practical question, what do you do? Start by measuring concentration. Honestly, if the top 7 stocks are 36% of the index and you own a pure S&P 500 fund, over a third of your money depends on them. If that 36% drops 40%, that's a 14.4% hit immediately. That's how a diversified portfolio becomes a retirement problem. Second, set a rebalancing rule, not a feeling. Rebalancing stops a 36% concentration from becoming 45% right before a downturn. If any sector grows 5% above your target allocation, trim it back annually. No forecasts, no predictions, just discipline. Third, hold liquidity on purpose. Liquidity keeps you from selling at the bottom. Not all cash, but enough that if markets fall 25 to 40%, you're not forced to lock in losses to cover expenses. In the 1970s, investors who needed money during the downturn locked in losses. Those with liquidity could buy quality at normal valuations. Liquidity isn't about timing the market. It's about surviving volatility without panic. Finally, pay attention to valuations. You don't need to predict recessions. You don't need to forecast inflation, but you should know whether you're paying 15 times earnings, 40 or 80. 15 times is normal. 40 times is optimistic. 80 times is perfection priced in. Perfection rarely lasts. This isn't about abandoning index funds. For most people, they remain one of the simplest and most effective investment tools, but simplicity is not immunity. When valuations are high and leadership is narrow, risk hides in plain sight. The goal is not to panic. It is to prepare. So if your $400,000 ever gets cut in half, it doesn't erase the next decade of your life. That's the math. The price you pay determines your return more than the story you believe. In 1972, investors confused great companies with great investments at any price. Some of those businesses survived and thrived long term. But shareholders who bought at extreme valuations waited years, sometimes a decade, just to break even. Great businesses can survive inflation, recessions, and oil shocks. Overpriced stocks cannot. Tonight, review your allocation. Calculate how much of your portfolio sits at the top. Run the 40% scenario. Preparation beats prediction. History doesn't repeat perfectly. Valuation math does. If you understand the math before the reset, you don't have to learn it the hard way.